The balance sheet is a list of our assets and liabilities at a particular point in time. Here's an organization and it's got assets of 10. It's got no other assets at the moment. And its net assets, therefore, are 10. If it makes a sale for cash, then its cash is going to go up by the amount of the sale. So it's 5, so its cash is now 15, and its net assets are 15. The cash flow statement is an explanation of how did the cash move from its opening balance, 10 in this case, to its closing balance, which is 15 in this case. And we list, or one way to do it, we can list off the receipts. The receipts are 5. There's no other cash movements in the period, so the inflow for the period is 5. The month, or the year, or the quarter, the week. The opening balance at the beginning of that period was 10. So the closing cash balance, which is the amount in the balance sheet, the second balance sheet, the balance sheet at the end of the period, in this case it's 15. So the cash flow statement explains the movement in cash between one balance sheet date and the next. So there's a balance sheet and cash flow statement. Another primary financial statement is the income statement, or the profit and loss account, the statement of profit or loss. So we write that up for this organization, for this period. Its income is the same as the cash receipt. There's a cash sale in the period. There's income, the amount it earned in the period, 5, happens to all have been received in this period. So there's a profit of 5 for the period. And the 5 profit explains why the net assets went up from 10 to 15. So cash sale increases cash. It increases net assets. And it's an item of income. Let's look at a sale on credit. So sale on credit, in other words, we're giving the customer time to pay. And we can have a third balance sheet. So the credit sale, let's say this is 6, will not be cash, but well, let's go first of all to the income statement. We are earning another 6. So we've made sales of 6, but we've told the customer, pay us when you can, or pay us in 30 days, more realistically. So we're going to have a receivable, an asset, which is the amount of money we're expecting to receive after the credit term. So there's no change in cash because we've supplied the goods or services, but we haven't required payment, but we would have issued an invoice, for example. So we will be collecting payment. and a future date. In the meantime, we've got a new asset, and the asset is the receivable. So our cash hasn't moved from the credit sale, starts at 15, closes at 15. So our cash flow statement is nothing paid, nothing received. The inflow for the period was none. So the opening and closing balances are both the same. Income for this period was 6. The income is a credit sale. So income for this period £6. Opening net assets for this period were 15. This figure here. Net assets increased by the amount of the receivable from our customer, which was 6, which is our profit for the period. So credit sales increase net assets. They don't affect the cash, and they're an item of income.